Well, hey everyone, welcome to the Money Nutritionist Show. I have a very special guest for you today. Out of Austin, Texas, his name is BrianFry, and he is the founder of Safe Landing Financial. So, welcome, Brian, to the show.
Thanks, Zach. I appreciate you having me. I'm looking forward to this.
Yeah, me too. And now, Brian holds his CFP license, the Certified Financial Planning designation, and he specializes in helping busy professionals to prepare themselves for retirement. So we're going to just start off by giving everyone a little bit of background to all those that are listening. So you did receive your bachelor's degree in finance from the University of Kansas. So it sounds like you've had some planning concerning your future. So do you mind telling us a little bit about how you got into financial planning and what led you to pursue your CFP?
Sure. Well, once again, thanks for having me on the show. And, I think everyone's got a different story, unique story on what got them to where they're at. And if we're being honest, I didn't ever pre-plan or, expect to be, at this point in my career. But, while I was in college as a finance major, I interned with a small group at Wells Fargo Advisors, and they were doing mostly investment management work, but I was really just helping on the day-to-day with their clients and more of the operations side. And I really enjoyed the interactions between the clients and the advisors, and they had me work on a couple projects in financial planning, mostly just data entry, and I really enjoyed that. It didn't really go with any of the classes that I was learning at Kansas, but after college, I was offered an opportunity at Wells Fargo Advisors to work with the financial planning group, and I really just kind of fell in love with the industry and the relationships and working with clients and really making that difference in their life. So, I worked with them for a handful of years, and what really inspired me to get the CFP and kind of go this direction I did is I went to a luncheon for the CFP in Kansas City and where I was working. And, I think just seeing how they do it and really putting more of a professional aspect to something, I just fell in love with it. And I realized that was the type of career path that I saw for myself. And I wanted to bring that type of expertise to my client relationships.
Mm-hmm. Yeah, and I really respect that. It's all about helping people, getting them to understand financial planning, setting them on the right path for retirement. And it sounds like it gave you a great feeling in doing that. And so how long have you been running your firm now?
So I've been in the industry since 2012 full time, but as far as Safe Landing Financial, that just started July of 2018. So just under a year and a half here, or just over a year and a half here. Had some experience doing this, but as far as running my own show, this is all new and very exciting to be able to offer my clients and really, offer that CFP expertise, planning expertise that I've learned.
And what type of clients are you working with at the moment?
I've worked with clients all over the board, you name it, but it seems like the clients I tend to work best with are, generally 10 or 15 years or less approaching retirement. Typically, they are either high earners or have saved up aggressively for retirement. And really what they're looking to do is try and best prepare themselves to get to that point where they can enjoy retirement on their terms, whether that means stepping away full time and vacationing or spending more time with the family, maybe volunteering for something a little bit more part-time, or maybe they have a passion project or a side gig that they want to turn into their full-time thing. So everyone's situation is a little bit different, and my expertise is really just to help give them more financial peace of mind for their situation.
Yeah, exactly. And now we've entered into a whole new decade. It's 2020. And if you are talking to a client, I know a lot of people have said this to me, it's a new year. Is there something we should be focusing on now that we're in a whole new decade? Things are changing very quickly. In your opinion, what's the biggest thing people should be aware of as we start moving into the future?
Well, there's a lot of different things. I'm sure you see it as I do. The rules change so quickly in our industry, so
Mhm.
really keeping track of everything, it's kind of hard to do it knowing where to start or what to look for. So the type of expertise that you offer with your educational series and what you do is really phenomenal. But uh, especially starting this new decade here in 2020, I think the rules really changed with the Secure Act that really were just established on January 1st here, so very recently. And it really impacts anybody that's still saving or planning for retirement. Um, all the tax and the estate planning rules have kind of changed a little bit. So, really keeping up to those standards and understanding how that impacts your situation. I really think that's a key thing to focus on for this year.
Yeah, no, I completely agree. Yeah, and the Secure Act's a big one. Things have changed already. They're going to change more. So you bringing that expertise to people is very exceptional. And it's tough to look at everything and read everything. That's why people need professionals that can help guide them down the path of retiring on time. So I appreciate you bringing that knowledge to everyone that's around you. And when it comes to investing itself, is there a certain type of investment style that you recommend for people?
I don't really see myself as the person to tell someone what's right or wrong from an investment philosophy. The type of philosophy I bring to my clients is really to manage your investments based on your financial goals and your risk tolerance. And, all that's usually established within a financial plan. So, instead of figuring out, what's the hot stock pick of the day or which ETF or mutual fund, passive or active, I definitely have my philosophy on what I try and bring for my client relationships, but without starting with understanding your financial goals and what's important to you and your family and what you're overall trying to accomplish. It's hard to really know all these things. Everyone's got a unique situation, so it's really important to start off from square one and just building your financial plan. And once you have a really good idea of what you need to stay on track and really achieve your financial goals, then you can start to pick out the nuts and bolts or different ETFs, mutual funds, stocks, bonds that really make up your portfolio.
And you mentioned a great term that I don't think is thrown around enough amongst regular people, which is risk assessment. So do you mind describing a little bit about risk for people so they understand?
Yeah, sure. So there's a couple different mindsets that advisors have had over the years, and what risk is really entailing is what should your portfolio look like? Not necessarily should you put everything all in one stock, such as like an Amazon or an Apple, but really we're looking at how much equity should be in your portfolio, how much in fixed income should be in your portfolio, how much in cash or alternatives should be in your portfolio. And so, really, the best way to determine what your asset allocation should look like is starting with your financial plan and understanding your risk assessment or your risk tolerance. So, there's a number of different ways you can do that. Uh, some advisors or some people like the idea that you can take 100 minus your age, and that's a good starting point for maybe how much equity you should have in your portfolio. And then, the opposite of that would be the amount of fixed income and cash maybe that should be in your portfolio. So let's say you're, 45 years old. Maybe that would mean your portfolio should be a 55-45 type mix. I don't necessarily agree with that. And I think there's a lot more complications that go into that. Uh, you really have to understand what you're trying to accomplish and what kinds of assets and income you have saved aside, and what you want to spend down the road to accomplish your financial goals. And maybe there's some kids or charities or other things in mind for your financial plan. So I think there's a lot more to it than just saying 100 minus your age should be your risk. But some other ideas or things to maybe consider for your risk tolerance is, what's your time horizon? Is this something that's maybe more for a short-term goal like college planning? Maybe you're looking to save for a down payment for a home, or is this maybe for retirement? If it's for retirement, you're probably looking to try and, from a conservative standpoint, make those assets last through age 80 or 90. So, that could be, 50 years right there. So
Hmm.
when you're trying to decide, the amount of time in your horizon is really important. And then how much risk can you stomach? What can you take? What kinds of ups and downs? Are you going to have the discipline if there's a market correction to be able to stay true to your asset allocation? And are you going to continue to rebalance over time? So, answering all these different questions, you probably don't want to be more aggressive than what you can handle, even if, let's say you're taking 100 minus your age, that's just not a good way to do it. Maybe somebody is older, maybe they're in their 70s or 80s, and their asset allocation based on the age would say maybe they should be like a conservative 20-80 type portfolio. That's frankly not looking at their overall goals. Maybe it's for retirement or saving for the next generation. Like there's just too many complications to do it that way. So taking an assessment can really help in understanding what you need. And I think it's a lot better than just saying take 100 minus your age.
No, I completely agree. Every 50-year-old or every 55-year-old is not the same. We're people. We're all different. People have different goals, different objectives. Some people are risky, some people aren't. So I think you're absolutely right with everything you just said there. I completely agree with that. And have you noticed anything when it does come to your clients that have changed over time, from, say, working at Wells Fargo and seeing that financial planning group in the beginning to working with people now thanks to the internet or cell phone technology or anything that's changed? What changes, if any, have you noticed when it comes to working with people and with your clients?
Gosh, there's been so many changes in the industry since I started. One of the shifts I've seen is really going, especially from a place like a Wells Fargo to where I was most recently at with Schwab, and in this current space I'm at, being a fee-only financial planner. There's been a huge industry change in that commissions used to be, a high amount, and it used to be something where it was just kind of expected as a way of payment. And kind of the rules have changed over the years, and so what you've seen is a huge shift from high commissions to low commissions. Even free, I guess. There's a lot of broker dealers out there like Schwab, Fidelity. There's several others that are offering $0 commissions. So that's been a huge shift since I've started. Another big one that we've seen over the years is the impact of robo-advisors. They can come in and manage your portfolio, assuming that you don't already have high unrealized gains, and really simplify the process, making sure that you don't really have to pay attention every day. They do the rebalancing for you. But it's important to understand, there's good and bad with robo, and so we're still kind of waiting and seeing what that looks like. And then the other side of fees, I think you're seeing this transition from financial advisors being able to charge over 1% for just the investments. And I really think that you're seeing this shift where it is becoming more important to really offer that financial planning, to offer that value to client relationships. And thankfully, that's where I come in. So, that's really been a very helpful thing to see over the years. And, I think last but not least, along with what we've seen with the shift in fee only and whatnot, it's becoming more and more out there, the difference in looking for someone that can serve as a fiduciary and not necessarily putting their interest first, but maybe putting the client's interest first. So I think that's really been the biggest things I've seen change over the years here.
And I do feel like fee-based advisors and fiduciaries, that term is starting to slowly become more known amongst people. I still mention it to some people now, and they give me the side eye, like, I'm not quite sure what you mean. So when you are trying to explain a fiduciary to someone, how would you explain that?
Well, I really think it's black and white here. When you're thinking of a fiduciary, they should be able to say that they're going to put your interest first, your best interest first, 100% of the time. They should be trying to limit their conflicts of interest and really bringing the best to your situation. Now, there's different ways that people can act as a fiduciary, but when you're thinking about fee-based versus fee-only, what you have to think about is someone that's fee-based can only act as a fiduciary some of the time. Maybe it's 90%, maybe it's 95% of the time, but a fiduciary should be able to act as a fiduciary 100% of the time. So that's why instead of fee-based, maybe I'd focus on fee-only. What exactly that could entail, let's say you have a relationship with an advisor that's charging commissions. Maybe they're trying to churn the portfolio a little bit more, or maybe they're following what's called the suitability standard, which is the opposite of the fiduciary. So if someone's not serving as a fiduciary standard, then they're serving under the suitability standard, which would mean that you may have two different products. They could be the exact same to you and how they would maybe react to the market. One may have a 1% fee. The other may have let's say a 0.1% fee, and the 1% fee could pay the advisor an additional 1%, and the 0.1% could pay the advisor nothing. So, what should the advisor do? The fiduciary is going to choose what's best for you. So they're going to choose the lower cost one that doesn't pay them more, because you have a relationship where they're supposed to serve as a fiduciary 100% of the time. Under the suitability standard, that advisor wouldn't necessarily have to choose the best product for the client. They could choose, what's suitable for the client. So that's an example of where maybe a fiduciary standard is really important to have in place.
Great. And I think that's a very good piece of knowledge that people need to start grasping, and I think they are slowly starting to grasp what a fiduciary is and what they do. So I'm glad we can start spreading this message a bit more as we start entering into the 2020s. Now, for people who are just starting out in their finances, they are getting older, they have their 401ks, they're really trying to start focusing on building a retirement account. What's one piece of knowledge that you'd like to leave with them?
Gosh, there's so many different things I'd want to leave for them, but I'd really just tell them to start small. If they're in the middle of their career, maybe trying to get towards that retirement planning area, make sure that they are, knocking out their high interest debt, making sure that they're focusing on building their emergency funds. Typically I recommend, having anywhere from 3 to 6 months when you're over 5 or 10 years away from retirement, and then trying to get that close to a year's worth of spending as you're really approaching retirement. So then, of course, making sure your budget's in order. You have to really make sure that you can handle the burden of saving. So once you understand what's possible and achievable within your budget, then focusing on how can you start saving more aggressively. And then, once you have all those pieces, you can really start to build your financial plan and start planning for retirement or other financial goals you have. So starting small, controlling what you can, automating what's possible, and if you feel that you don't have the time, the interest, or desire, or expertise to necessarily manage your financial plan or investment strategy, look to work with someone that you can trust and that can help you get your feet on the ground.
And I think that's perfectly said, because starting small, having the emergency fund, and for me, the biggest one, automating it. Put it on autopilot and let it do its thing. So that's one that I always preach as well. So I think we've unpacked a ton of information in a very short period of time, Brian. So I do want to thank you for coming on the show and sharing your expertise with everyone. And if someone wants to reach you, what are some contact methods? Where can they find you?
Yeah, sure. So thanks for having me. And the best way for someone to reach me, my email address is just BrianFry@safelandingfinancial.com. My phone number is 512-662-1835. And you can also reach me at my website, which is just safelandingfinancial.com.
Perfect. Well, thanks, Brian, and I hope that I get to talk to you soon in the future. I will definitely see you on Twitter. So thanks for coming on the show.
Thanks for having me, Zach. I appreciate it.
All right. Take care.
Thanks for watching. Be sure to follow me on Twitter, Instagram, and Facebook to stay updated on the latest. But more importantly, to stay updated on YouTube, press the subscribe button below.